Hey guys, happy Thursday. I wanted to do a video that will hopefully teach everybody something. And so one of the questions I've been getting a lot over the past couple weeks, since it's renewal season for most January 1 renewals, people are looking right now, is about different funding mechanisms. And I've explained this a couple different ways. One of the easiest ways that I've found to explain this is with simple coins. So we will start off with the least risky type of funding. So I have in my possession 2 quarters, 4 dimes, 2 nickels. When you are fully insured, the carrier will do something most of the time for small to mid groups called GRX underwriting. They will look at your demographics. Based off your population, they can make reasonable assumptions about what's going to happen in your population. Somebody takes insulin, it's very natural to assume that they're a diabetic. If somebody takes blood thinners, very natural to assume that they've got high blood pressure, hypertension. Based off of their predictions, they will come up with a premium rate. That premium rate is what they assume that the group will consume in healthcare. Now, regardless of whether the group consumes that much or not, that is the rate. So all of this dollar goes to the carrier. Sometimes the employer comes out positive on that because they've had a bad year. Sometimes they come out negative. If the employer performs better than they're expected, they get no reward for it. So there's no upside of it. The only upside of it is that it's the lowest risk. It's the first funding mechanism, fully insured. Second one is level funding. We take that same exact dollar, but we split it. We're gonna take 4 dimes, so we're taking 40 cents. And that we're having as fixed administrative costs. You're gonna have things like commission in there, stop loss insurance, and administrative fees for the carrier. It'll look and feel a lot like fully insured in terms that premiums will remain consistent. At the end of the plan year, you'll have no extra financial liability if your plan performs bad. The upside to level funded or graded funded is that you have the potential to share in the surplus. So since 60% of your dollar is up for claims, if you only spend 50 cents, 2 quarters, what's going to happen is with that 10 cents that's left over, half of it's going to go to you, half of it's going to go to the carrier. Potential to get some money back if you perform well. If you don't perform as well, no harm, no foul. You just get an increase in your premium just like you would with normal fully insured. The upside to it is you get limited data, so you can see where your healthcare cost drivers are coming from. So it'll help you get some insight into knowing if you want to go self-funded at some point in the future. First 2 funding mechanisms, fully insured, level funded. The third one is going to be a captive. So Rachel Miner will say Megan Chiarello, and we will say Nama Opozniak want to buy something in terms of health insurance, but we don't necessarily have enough people to have a law of large numbers or enough clout. What we do is we form a captive. It's like-minded employers who all want to be self-funded but want to kind of spread out the risk. So what we do with that dollar is we take 20 cents of it, we put that towards fixed administrative costs. What we do with the rest of the dollar is this is our claims bucket. It gives us more control in terms of we can carve things out. We can start pulling different levers to have cost containment strategies. The positive thing for smaller employers, I would say in like the 50 employee to 250 employee, is that it spreads out your risk. You don't have the volatility of if you were fully self-funded. There is a stop loss insurance that you purchase. There is a captive layer where the captive insures itself, and then there's a reinsurance layer. So if you only spend, let's say, an additional 40 cents for your insurance, what ends up happening then is we get to keep the additional 45 cents that we have left over. The cool thing about captives is that it's definitely a way to tiptoe into self-funding, and it's a way to spread out your risk of large numbers. It also gives you more purchasing power in terms of stop-loss insurance. You can get more favorable terms. Things like rate caps, no new laser policies, things like that. The last funding mechanism, so we talked about fully insured, talked about level funded, talked about captives. The last one is self-funded. We'll have a lot of different components that the captive has in terms of, you take that same 20 cents, we put it towards fixed claims, or fixed event costs, sorry. So that'll still be the stop loss insurance. It'll still be your TPA expenses. It'll still be the broker fees. And then we have 80 cents that's up for grab. So this is our claims bucket, similar to the captive. The positive thing about the captive and self-funding is that anything that's left over goes back to the employer. So in the last scenario, I think I had said 40 cents was what I had left over. If you find out that you have health care cost drivers that are super, super, super expensive, what you can start doing is you can start having cost containment strategies. It's very cool in terms of all of the different control that you can have in a plan. The downside to it is there is a different strategy with self-funded versus fully insured. It's definitely a little bit of a learning curve in terms of some months you'll have no claims, other months you'll have a lot of claims. For those who are looking to take more control, self-funding is definitely the way to go. A claim is a claim, true, but if you can have a claim be a lower claim than it initially was, you're going to be spending less money. Hopefully this is informative. If anybody has any questions about it, please let me know. This is something I've been asked by a lot of employers, and I've done this in a couple different presentations, so figured that I'd show you guys. If you have any questions, shoot them down below or write me a direct message. Thanks so much, guys. Have a great day. Bye.